Every trader believes their downfall will come from one catastrophic moment. A bad trade, a sudden crash, a violent reversal they never saw coming. But Jesse Livermore said the opposite. A trader's collapse never begins on the day they lose money. It begins on the day their behavior quietly changes, not loudly, not dramatically, not in a way anyone else can see. It begins with something small. So small, most traders don't even notice it. A slight shift in discipline, a tiny break in routine, a moment where the trader says the four most dangerous words in the market. Just this one time. Livermore warned that these little deviations, these microscopic cracks in behavior, always appear before the major losses. And if you can learn to see this shift early, you can prevent the entire downfall before it ever arrives. Picture a trader who's been doing everything right for weeks. Let's call him Daniel. Daniel wakes up early, reviews his notes, checks the pre-market, and plans his day. He's been disciplined, almost mechanical, and his results have been steady. Not explosive, but consistent. The kind of consistency only a trader with self-control can achieve. And because of that, his confidence has been growing, but quietly, the way confidence should grow. No arrogance, no switching systems, just steady progress. But this is exactly when Livermore said traders are at their most vulnerable. Not when they're losing, but when they've been winning for just long enough. Daniel sits at his desk, opens his charts, and sees a stock starting to move sharply. The candles are strong, the momentum looks clean, and for a moment, his heart beats a little faster. He's seen this pattern before, but he's also seen it fail many times. His system, the one he's been following religiously, says, no entry yet. Wait for confirmation. He knows this rule. He trusts this rule. This rule has protected him again and again. But today, something feels slightly different. Not the market, not the chart. Him. A quiet voice inside whispers, I already know where this is going. I've seen this move. I can get in early. Just this once. And here's the part that Livermore understood better than anyone. The danger isn't the early entry. The danger is the thinking behind it. Because a disciplined trader reacts to the market. A drifting trader anticipates what they want the market to do. And that's the subtle shift, the psychological pivot point, where a trader stops being a student of the market and starts believing they're smarter than it. Daniel doesn't slam his fist on the table. He doesn't rant. He doesn't panic. He's calm, very calm. And that's why he doesn't notice what just happened. He didn't break his system. He broke something far more fragile, his identity as a disciplined trader. He clicks by. No confirmation, no waiting, no hesitation. It feels harmless. It feels justified. It even feels smart. He believes he's simply acting on experience. But Livermore would say something else. The moment Daniel acted on instinct over rules, his entire trading foundation quietly shifted. And that single shift, invisible in the moment, is the first domino in a chain that eventually leads to every major downfall. Livermore had a name for what Daniel was experiencing. He called it the loss of impersonal judgment. The moment a trader stops seeing the market for what it is and starts seeing it through the lens of emotion. And it never happens suddenly. It happens exactly like this, quietly, gradually, and dangerously. Because the instant Daniel clicked by, something subtle but powerful shifted inside him. He no longer needed confirmation. He no longer needed alignment with his system. He believed he could interpret the market instead of observe it. Livermore warned that this is the most seductive trap a trader can fall into. The belief that you're finally good enough to bend your own rules. At first, everything seems fine. The trade begins to move a little against him, but it's not alarming. A small pullback, nothing unusual. Daniel tells himself exactly what thousands of traders tell themselves every day. It's just a dip. It'll reverse soon. I know how these patterns behave. But without realizing it, he's no longer analyzing price. He's defending his decision. That's the shift. A disciplined trader asks, what is the market doing? A drifting trader asks, how can I justify staying in this trade? To an outside observer, Daniel looks the same, focused, calm, still in control. But internally, he's crossed a boundary that every trader should fear. He's more invested in being right than in following his process. Livermore wrote extensively about this phenomenon. He said traders rarely lose because they're wrong. They lose because they refuse to recognize they're wrong. And in Daniel's mind, exiting this trade early would mean admitting he made a mistake, that his quick entry wasn't justified, that his instinct was nothing more than impulse dressed in confidence. So he stays. And when the price dips dangerously close to his stop loss, a new thought appears, a thought that only rises when a trader has already begun to drift. I'll just move the stop a little lower. Not a huge change, nothing dramatic, just a small adjustment, just this one time. And now the behavior shift is no longer subtle, it's structural. He's bending his rules to protect his ego instead of his capital. The market isn't punishing him yet. There's no explosion, no wipeout, no sudden crisis. But that's exactly why this moment is lethal. The real damage isn't done to his account. It's done to his discipline. And that is always where the real downfall begins. Daniel doesn't know it yet, but he has entered the most dangerous phase of a trader's psychology, the phase where the market is no longer the opponent. His opponent is now himself. The chart continues drifting downward, slowly, almost gently. Not enough to frighten him, just enough to tighten the knot in his stomach. He watches every tick, every candle, every tiny fluctuation. And the longer he watches, the more deeply he becomes emotionally attached to the trade. It's no longer an idea he executed. It's a statement about his intelligence, his skill, his identity as a maturing trader. That subtle internal shift turning a trade into a test of self-worth is the exact behavior Livermore spent his life warning against. He wrote that the moment a trader begins to care about a trade, truly care, the market has already won. Because caring leads to hope, and hope, in the markets, is poison. Daniel tells himself he's being patient, decisive, experienced. But the truth is harsher. He's rationalizing. He's rewriting the story in real time to make himself feel safe. This is the part of the downfall that remains invisible even to the trader experiencing it. There's no panic yet, no desperation, just a slow dissolving of boundaries, one rule at a time. The trade drops a little further. Now it's below his stop-loss level, the level he promised himself he would honor without exception. But since he already moved the stop once, moving it again doesn't feel like a big deal. It's temporary. He whispers to himself, the market is just shaking people out. I've seen worse pullbacks recover. Notice the pattern. Every sentence starts with I, not with the system, not with the data, not with the market. This is what Livermore meant when he said traders begin to think differently, just slightly differently. The change is microscopic at first, but its consequences are enormous. Daniel is no longer trading the chart. He's trading his beliefs, his emotions, his fears, and once a trader's decisions shift from rules to emotion, the slope becomes slippery, almost impossible to climb back from in the moment. The chart finally breaks through a key support level. Objectively, the trade is dead. A disciplined trader would exit instantly. No hesitation, but Daniel hesitates. Not because he doubts the chart, but because he doubts himself. What if I close it and it reverses right after? No, I need to give it room. I can't take a loss like this today. He doesn't realize it, but he is no longer managing a trade. He is managing his emotional discomfort. This is the quiet stage of the downfall, the part that feels recoverable, the part that feels manageable. But Livermore knew the truth. Once a trader begins fighting their own mind, the battle is already lost. Asterisk, this is the moment Livermore feared the most, the moment when a trader's behavior becomes self-reinforcing. Daniel is still holding the trade, now deep in the red. He could exit at a small, manageable loss, but his mind refuses to let him. Every instinct says stop, cut, exit, but every thought justifies staying. It's only temporary. It'll bounce back. I can't show weakness today. These are not market observations. These are emotional rationalizations. This is the trap that keeps traders in the danger zone long after it has formed. Livermore said most traders don't fail because of a single bad trade. They fail because of what happens after they deviate from their rules. It begins with hope. A little hope. Maybe it will recover. A trader clings to that hope like a lifeline, never realizing it's the anchor dragging him under. Then comes ego, the desperate desire to be right. the stubborn belief that their decision must prove itself, regardless of evidence. Daniel doesn't want to admit he was wrong, and that is now controlling his every action. Next comes paralysis, the inability to act decisively. Even when the chart screams for action, he freezes. He hovers over the exit button but can't click. Every second of hesitation makes the loss worse, not better. And then, the subtle compounding of mistakes begins, moving the stop loss lower, doubling down in an attempt to average down, rationalizing the impossible. All of it feels harmless because each action is small. Each step seems justified. Each decision feels like a rational adaptation. But Livermore knew the danger is cumulative. Small deviations grow silently. They compound. And one day, the trader wakes up to find themselves in full-blown disaster. Daniel doesn't see it yet. He thinks he is still disciplined, still in control. He is neither. He is trapped by the very emotions he once mastered. This is why Livermore emphasized the rule that saved him repeatedly. Cut the loss the moment. The reason for the trade no longer exists. Not later. Not after hoping it will turn around. Not when the ego screams louder than the logic. Now, this rule is simple but brutal. It separates the survivors from the casualties. Because the subtle behavior change that Daniel displayed, the shift from disciplined observation to emotional interpretation, is reversible, but only if recognized early and acted upon immediately. Fail to recognize it, and the consequences escalate. Every hesitation, every rationalization, every just this once builds the trap tighter. And once it's fully formed, the market doesn't even have to act to punish the trader, he punishes himself. Livermore's brilliance wasn't in predicting the market. It was in recognizing invalidity in real time, in acting instantly, and in creating a mental framework that forced decisive action. This is the point where the trader either survives or begins the slow, inevitable decline that destroys accounts and confidence alike. Livermore understood that rules alone were not enough. A trader could memorize every principle, every stop loss, every system, but when the pressure hits, knowledge without execution is useless. That is why he developed what he called the mental trigger, a question so simple, yet so powerful. It forces instant clarity. If I would not open this trade right now, why am I still in it? This question slices through every excuse, every rationalization, every whisper of hope. It exposes the truth that the trader often refuses to see. The trade no longer belongs in the portfolio because it has ceased to be valid. Daniel, sitting in front of his screen, would have been paralyzed by emotion. But if he applied this mental trigger, everything changes. His mind suddenly steps outside itself. The layers of attachment, fear, and ego fall away. He sees the trade as it is, not as he wishes it to be. This is the genius of Livermore's method. It converts hesitation into action. No debate, no struggle, no waiting for a better moment. If the trade is invalid, it must end. Not tomorrow, not after a bounce, not after the market proves him wrong. Now, the mental trigger doesn't only work in theory. It works because it engages the brain's objective, neutral mode. The part of the mind that judges, analyzes, and decides logically. The part of the mind that made Daniel disciplined in the first place. But now, it's activated at the precise moment when emotional chaos threatens to override reason. Daniel asks himself the question silently, would I open this trade now? He stares at the chart, at the red candles, at the psychological tug-of-war inside him. His answer is clear. No, not under these conditions. He would never enter this trade if starting fresh. And suddenly, the justification for holding it disappears. The trade is stripped of hope, of ego, of wishful thinking. The only remaining action is obvious exit. Immediate, clean, decisive. This is the bridge between knowledge and survival. It is the mechanism that turns theory into practice, principles into results. Without it, even the most disciplined trader can fall prey to the subtle behavior changes that precede disaster. With it, even a trader under extreme pressure can act rationally, protect capital, and preserve confidence. Livermore knew that the hardest part of trading is honesty. The mental trigger forces the trader to be honest, not with anyone else, not even with the market, but with himself. And that honesty is what prevents a small deviation from snowballing into full-scale ruin. This is not just a tool, it is a lifeline. a method to regain control before the danger zone closes around the trader completely. Survival in trading isn't only about escaping the danger zone once you're in it. True mastery comes from never stepping into it in the first place. Livermore didn't rely on luck, intuition, or hope. He relied on structure, a disciplined framework that prevented small behavioral shifts from ever turning into catastrophic losses. He built this structure around every trade so that danger would be obvious before it could touch him. The first principle of this structure is start small, scale only into truth. Livermore never entered full size at the outset. He treated every initial position as a probe, a test to see if the market truly supported his thesis. If the market reacted as expected, he would scale up carefully. If it didn't, he would exit immediately, limiting both emotional attachment and financial risk. Small positions keep the mind sharp. Large positions blind it. The second principle is let the market confirm your belief. Livermore didn't predict. He observed. He waited for confirmation of structure, momentum, and reaction. Most traders skip this step, jumping in at the anticipation stage instead of waiting for evidence. By letting the market validate or invalidate the idea, Livermore kept his trades objective, controlled, and free from emotional contamination. The third principle is never hold a trade the market has rejected. If price breaks a key level, if momentum dies, or if the idea fails, you do not negotiate. You accept the market's verdict. Remaining in denial, hoping the trade will return, is the fastest path into behavioral drift. The fourth principle is keep your capital liquid, nimble, and ready. Livermore knew that opportunity is scarce, and being trapped in a single position limits your ability to strike when a true edge appears. Staying out of the danger zone ensures you have the freedom to act decisively when real opportunities arise. The fifth principle is build conditions, not predictions. Traders who forecast outcomes are constantly fighting uncertainty. Traders who focus on conditions are responding to reality. By defining exact conditions for entries, stops, and exits, Livermore created a system that clearly dictated action or inaction. When the conditions disappear, so does the trade. This structure is more than rules. It's a shield against subtle behavioral decay. It makes the invisible visible. It makes the unknowable predictable. But even the best structure is useless without the emotional discipline to obey it. Many traders can memorize these principles, but only those who respect them, enforce them internally, and act without hesitation escape the psychological traps that destroy accounts. Livermore survived not because he was lucky or clever. He survived because he created a framework in which danger could never hide, where the subtle signs of drift were amplified, recognized, and corrected before they became fatal. This is the art of prevention, far more powerful than any escape plan. Having structure is one thing, obeying it under pressure is another entirely. Rules and frameworks are useless if the trader's emotions collapse at the first sign of adversity. Livermore understood this better than anyone. He knew the real enemy in trading is not volatility, manipulation, or market noise. It is the trader's own mind. Emotional discipline is what turns structure into survival. Without it, even the clearest rules will fail, and the subtle behavior shifts we've discussed will take control. Every trader faces the same internal enemies, but only a few recognize them before disaster strikes. The first enemy is impatience. The trader thinks, "I'll miss the move if I don't act now." This whisper destroys discipline. It pushes the trader to ignore confirmation, enter early, or overcome it. Livermore countered impatience with patience, understanding that the market is always there tomorrow. But capital is finite. Patience is not passivity. It is vigilance. It is profitable. The second enemy is ego, the desire to prove you are right. A trader's ego can blind them to evidence, make them romanticize their trades, and rationalize mistakes. Livermore detached his identity from his trades. Success was measured not by being right, but by being profitable. Winning traders adapt to the market. They don't force the market to adapt to them. The third enemy is fear. Fear freezes execution. It tells you to hold a loser, avoid a winner, or hesitate at critical moments. Livermore neutralized fear by accepting one principle: the market is never wrong. Only the trader can be. When fear is reframed as a signal rather than a threat, hesitation evaporates. The fourth enemy is hope. Hope prolongs suffering. It whispers, "It'll come back, just give it time." Hope is the most expensive emotion because it keeps traders trapped in bad trades. Livermore replaced hope with evidence. When the evidence failed, he acted immediately. The fifth enemy is overconfidence. After a streak of wins, the mind begins to believe it is untouchable. This illusion of control is silent but lethal. Livermore survived by respecting risk even when winning, understanding that the market can humble anyone at any moment. The truth is simple: structure protects you, but emotional discipline activates it. Without discipline, the rules collapse. The subtle behavior changes that predict a trader's downfall take over. The danger zone becomes the trader's home, and the market only amplifies the consequences. Discipline is the bridge between knowing and doing. It's what allows a trader to obey the mental trigger, follow the structure, and prevent small deviations from snowballing into total destruction. Understanding. Emotional discipline is understanding the difference between surviving and being destroyed in the markets. The final piece of Livermore's method is recognizing the danger zone before it fully forms. This is the moment most traders miss: the subtle behavior changes that quietly signal impending disaster. These are not dramatic shifts. They are almost invisible if you're not paying attention, but they are consistently present before every major loss. It begins with small compromises. The trader starts bending the rules just slightly. Stops are nudged, position sizes are increased impulsively, or entries are made without proper confirmation. Each deviation feels minor, almost harmless. The mind reassures itself, just this once, it'll be fine. But Livermore knew these tiny cracks were the beginning of a collapse. Next comes emotional reasoning. The trader starts making decisions to protect their ego rather than the trade itself. Thoughts shift from "what does the market tell me?" to "how can I justify staying in this trade?" This subtle swap of perspective is invisible externally, but internally it's catastrophic. The trader is no longer managing risk. They are managing feelings. Another early warning sign is obsessive monitoring. The trader refreshes charts, watches every candle, and becomes hyper-focused on minute fluctuations. This is not discipline, it's anxiety masquerading as vigilance. Livermore called it the first psychological entry into the danger zone. The market hasn't yet punished the trader, but the mind is already trapped. A fourth indicator is hope. The trader begins whispering to themselves, "It'll turn around. Just a little longer." Hope replaces objective evaluation. Hope is addictive because it temporarily relieves emotional discomfort. But in trading, it is poison. Every moment spent clinging to hope compounds potential loss. Finally, the most dangerous sign: hesitation at the exit. The trader has a clear opportunity to cut losses, but hesitates, rationalizing why holding is better. This is the point where the subtle behavior change becomes actionable. By now, the trader has allowed emotion to override rules. The danger zone is no longer looming, it has already arrived. Livermore emphasized that spotting these behaviors early allows the trader to correct course. Cut the trade immediately. Reassess the plan. Reset the mind. Acting before the behaviors escalate into fully realized losses is the only way to survive. Recognizing the danger zone before it forms is not about predicting the market. It's about reading yourself, understanding when small deviations from discipline, rationalization, hope, and hesitation are creeping in. These are the signals no indicator will show, no chart will confirm, but they are more reliable than any technical setup. The traders who succeed are those who see the invisible before it becomes unavoidable. They catch the subtle behavioral drift, apply the mental trigger, and act decisively. By mastering this self-awareness, you prevent a small error from becoming a full-scale collapse. This is the power of the Livermore method. It teaches you to see the danger zone forming in your own mind and gives you the tools to step away before it destroys your trading account and your confidence. Now, imagine everything we've discussed: the subtle behavioral shifts, the creeping hope, the bending of rules, the hesitation, the obsession, the ego, the fear, all coming together in one scenario. This is the moment every trader dreads, but few recognize: the full unfolding of a downfall that began long before the account showed red. Livermore's genius was that he didn't need a market crash to survive. He needed self-awareness. He needed structure. He needed discipline. And most importantly, he needed the ability to spot these tiny changes in behavior before they became catastrophic. This final stage is about mastery. Mastery over the self, not the market. When a trader recognizes the subtle warning signs early, they can act decisively, protecting both capital and confidence. They exit trades cleanly, reassess their system, and re-enter only when the conditions truly align. No hesitation, no hope, no ego. Only evidence, only reality. The truth is simple. No market move will destroy a disciplined trader who obeys their rules and respects the signals of their own behavior. The danger zone is created not by volatility or price movement. It is created by human nature, by impatience, by pride, by fear, by hope, by subtle deviations from what you know is right. Livermore recognized this and designed a system to counter it. Every trader can do the same. It begins with observation, watching your own decisions, your impulses, your reasoning. Then comes the mental trigger. If I would not open this trade right now, why am I still in it? This question immediately cuts through emotion and forces clarity. Finally, the disciplined application of structure, small entries, scaling only with confirmation, liquid capital, and conditions-based trading prevents small behavioral cracks from ever becoming fatal. The subtle behavior changes that predict a trader's downfall are not complicated. They are human, they are internal, and they are consistent. But with awareness, discipline, and structure, you can spot them, act against them, and prevent them from destroying your account. Livermore survived and thrived not because he predicted every market move, but because he predicted himself. He understood the traps of human nature, the danger of hope, the poison of ego, the paralysis of fear, and he built a framework that allowed him to see these traps forming, even when they were almost invisible. For you, this is the lesson. The market is not the enemy. Your own subtle behavior changes are. Master them. Obey your rules. Apply the mental trigger. Respect structure. And you will never let a small lapse grow into a full-scale downfall. The secret to survival is inside you, long before the market can punish you.